Well, it's interesting. There's a tremendous amount of volatility in this market, obviously, Scott. And right now, a lot of the trading that I'm doing is going on in the derivatives market, futures and options. Today has a very defensive feel to it, unfortunately. You had technology down, financials down. Energy is actually down with the spot price of oil, which is expiring tomorrow, pushing towards $88. Utilities higher, consumer staples higher as well. So there is this overall defensive feel. However, I do think we are in the process. We are in the process of trying to find a bottom for the component of technology where the free cash flow generation is here and now. It's present. And that's a lot of the companies like a Microsoft, like an Adobe, like a Cisco, like an Oracle, not the innovation technology. So bottoming is not a moment in time. It's a process. And I think we're at the stages of doing it. One last point, we pierced in the Qs below the January 10th low, and we quickly snapped and reversed higher, and we're following through right now.
So Liz, we're below the 200-day moving average on the NASDAQ. We broke below that level. And Apple is kind of the only of the majors, if you will, holding on for dear life right now to break away from correction territory. Alphabet's in it, down 10% from its high. Microsoft, 12%. Amazon, 16.5%. Meta, the former Facebook, 16%. NVIDIA, 27% from its high. Apple's 8%. What are you watching most importantly right now?
Well, one of the things that I think is really important to point out is that we've had dip buyers in this market, particularly in the NASDAQ, right around that down 6 to 8% level for the last year and a half. And then finally this year, that has broken down. So what we saw yesterday obviously dipped below the 200-day moving average. Those dip buyers come in, but they don't stick around as long. So now it's a matter of what are they buying and how long are they going to hold on to it? And I think there's three things that investors need to remember in 2022. Fundamentals obviously matter. Valuations finally matter again. And you also have to look at the financial health of a company. So this is a time period where you're looking at, you can evaluate companies based on fundamentals and valuations, and both of them should trigger. Last year, we couldn't really do that with valuations. Everything was so expensive. Now we're looking at a time where things are going to meet up and it's going to make more sense. I think the big tech names, obviously this year, are not going to be the huge standouts given the environment. But there's a lot of other places in the indexes that can come in and take the lead. We just have to step away from that tech stuff, not fall so much in love with it, and fall in love with some of the other spaces. I would still hold on to that cyclical trade, and I'm still holding on to a small cap call.
All right, so Steve Weiss, you told our producers this morning it's a, quote, do-nothing market, yet you are doing something, and that is back shorting. The Qs and the SMH, among other things, but let's talk about those two first. Why you put that on again?
Those are hedges. So I'm not really expressing a view that I think, directly that the Qs or the NASDAQ is going to go down dramatically. Nor am I expressing a view that the semi index is going to go, although I'm a little cooler on semis than I have been after TSM came out last week and said China demand has really fallen off a cliff in what should be a seasonally strong time, and that's for cell phones specifically. But I just think this is a do-nothing market. By that I mean that I think people are still too optimistic while crying in their milk, so to speak. And here's why I say that. Look, momentum got us to where we were, hitting new highs virtually every day on what was historically easy money for an historically long period of time with a balance sheet, again, historically higher than it's ever been. So there's this feeling that momentum can't cut both ways. So I believe that it can. And I believe we'll continue to overshoot in the downside in stocks that are cheap. Take a look at Applied Materials. I think that's an inexpensive stock. Multiples are still way too high. We've got forward multiples on the NASDAQ at about 27, 28 times. Historically, it's 20. And you're in a massive tightening cycle. So there'll be better times to get in by neutralizing my exposure. I'm still net long 50 to 60%, depending upon the day. By neutralizing my equity exposure, I'm going to not worry about what's going on up or down, and I'm not going to miss it. The market's not going meaningfully above where it is now for any period of time while we're in this tightening cycle. And the surprise still is a more aggressive Fed, period.